Well, we are in the early stages of what is probably going to be a 2-year recession. So that's where I think we are right now. And the beauty about this call is that it is separates itself from the consensus view that we're going to experience a soft landing um, or a short and shallow recession. It could be shallow. It's not going to be short. That's where we are.
Macro investing is a journey. Join me, Raoul, as I go on a journey of discovery through the macro landscape. This is how I build my macro framework, by talking to the smartest people in the world. Dave, great to get you back on Real Vision, and exactly the person I wanted to speak to. And I've got in your honor, but buy bonds, wear diamonds.
Well, you could buy diamonds and you can wear bonds, except I don't know what that look is going to be, but I appreciate you wearing that on my recommendation.
Yeah, I mean, I'm the same way biased as you, so I'm very much of I'm focused on bonds right now.
Well, let me just tell you something, that you wash that shirt in cold water and it will deflate.
So, Dave, wanted to catch up with you what your thoughts are now, where we are, first bigger picture, and then we'll zoom into exactly where we are in the cycle.
Well, we are in the early stages of what is probably going to be a 2-year recession. So that's where I think we are right now. And the beauty about this call is that it is separates itself from the consensus view that we're going to experience a soft landing or a short and shallow recession. It could be shallow. It's not going to be short. That's where we are.
So I've actually come from a different perspective. I thought it's going to be sharper and shorter. Where's the length come from? Is it the length of the bear market potentially as earnings come down, or the recession itself? Talk me through that framework, how you've come to, because you're the first person who's really talking about a long recession.
Mm.
Where does that come from in your framework?
Well, it really comes from what the catalyst is going to have to be to get us out of the recession, which is, it looks like it started even earlier than I thought. I'll just say at the outset that although back-to-back negative quarters of GDP isn't the technical official NBER defined recession, it's a Wall Street rule of thumb because it always works. Whenever you've had back-to-back negative quarters, you've been in recession. Whenever you've had 2 quarters down out of 3, you've been in recession 100% of the time. So that's where we are. There's really no doubting it unless you want to attack the historical record. But you see, the reason why I think it's going to be long is because it's already started. And so has the Fed tightening cycle, just started in March. And the peak impact on the economy from whatever the Fed does, whether it's easing or whether it's tightening, there's lags involved because the economy ongoingly resets to a different interest rate regime. The lags are generally about 12 months. And the Fed only started raising rates in March, and they've gone a long way. They've gone 225 basis points. And even once they pause, they're still going to be undertaking balance sheet reduction. So they'll still be tightening policy even after they move to the sidelines in interest rates. And so once we acknowledge that we're in a recession, and I think it's going to take the consensus some time, because when you really look back, say, to the great financial crisis, the recession wasn't acknowledged really until Lehman collapsed. The view was that it was a soft landing. And you go back to the tech wreck, and people were surprised that the NBR actually called it a recession that started in March of 01 and ended in November. The bottom line is that once you get into recession, you need a catalyst to get out. And there is no catalyst from fiscal policy. Fiscal policy continues to operate in a way that is contractionary for the economy. So the question is going to be, what is the catalyst? And I think ultimately the catalyst will be a move back to disinflation that gives the Fed the opportunity to ease monetary policy. But that's not going to happen immediately. And we have a situation where the Fed has been shamed because it blew the inflation call, chose the wrong word because although they weren't wrong on transitory doesn't have a timestamp in any definition. But they panicked. The Fed, even in the face of back-to-back quarters of negative growth, and it's a debate as to whether or not Jay Powell saw today's GDP report yesterday, the Fed has been tightening into a recession, which really only happened during the Volcker era in the early 1980s when you had back-to-back recessions separated, a year apart. You could almost argue that whole period was about a 3-year recession. And you have a central bank chief who in March in front of Richard Shelby at a Senate committee presentation, Powell did not compare himself to Arthur Burns or William Miller or Alan Greenspan or Ben Bernanke. He brought up the fact that Paul Volcker was the greatest economic public servant who ever lived. And we know that Volcker killed inflation by killing the economy. So I'm getting a sense here that, what's remarkable, people are questioning whether or not the Fed is going to go again in September. Of course, now they're data dependent. They're no longer pre-committing. But the bottom line is that even in the face of this economic malaise, he retained a de facto tightening bias. And that speaks volumes because it tells me that it is going to take a lot to get this Fed to start to ease monetary policy again, which means they have to stop quantitative tightening and cut interest rates. I think that will be next year's story. And then there's going to have to be a lag because historically the recession ends towards the tail end of the Fed easing cycle. The recession doesn't normally end in the early stages. And I could see people would be shaking their heads. What's he even talking about? But it's an answer to your question. We are in the early stages of a recession and the Fed is still tightening monetary policy. Why would anybody think this is going to be over quickly? The historical record is very clear. You need a catalyst to stimulate the economy once a recession starts. It's normally monetary policy. Frequently, it's been monetary and fiscal policy. Fiscal policy is out the window. And the bottom line is that it looks as though the Republicans are going to take the House and the Senate in November. There's no fiscal stimulus coming for a long period of time. It's all going to be on the Fed. And it looks as though the Fed's not going to do anything until it sees the whites of the eyes of inflation, headline inflation, heading back down towards its target. So you could argue they were late. They were late to tighten policy. They're probably going to be late to ease policy. But that tells me that when I trace through the lags between what the Fed does, trace it through to what it means for the economy, I think we're looking at a 2-year recession. I don't know so much about the magnitude. So much of that will depend, I think, on the extent to which we have a big negative wealth effect on spending if the housing market joins the equity market in an asset price deflation. I think that's quite possible. The extent to which these high cash balances just stay as high cash balances on the household balance sheet instead of diverting its way into the real economy, which is what most economists and the Fed thinks. It's hard to say how deep it's going to be. I probably have more conviction over its duration. And that's actually, I think, more important because there is no correlation between the severity of the recession and what the stock market does. It's much more important timing when the next recovery is going to start, because historically the stock market puts in the fundamental low 2/3 of the way through the recession, whatever that low is going to be. Will it be 10% down, 20% down, 30% down? The major point is that instead of trying to pick at what point we bottom, it's more important to identify when is the start of the next bull market. When will that start from whatever level it's going to be? And historically, that's 2/3 of the way through the recession. That is actually when people say that nobody rings the alarm bell at the lows Well, actually, if you can try and time the contours of the economy through the lags from Fed policy, you can come up with a reasonable approximation as to when, as opposed to what level, but the timing of when it's going to be safe to dip toes back into the risk pool, outside of these intermittent bear market rallies. What's the fundamental low? The fundamental low takes place at the tail end of the Fed easing cycle and the tail end of the economic recession. So that's next year's story, probably second half.
Hi, I'm Raoul Pal, the CEO and co-founder of Real Vision. The financial world is a complicated world right now. It's a really complicated macro picture, and there's a lot of risks. Real Vision and our YouTube channel help you navigate those risks. So subscribe now to the channel and never miss an update. There is simply too much going on. So subscribe now. Thank you. So one of the things I've looked at is that the markets and the commodity markets. So I created an indicator of rate of change of rates, rate of change of commodity prices, rate of change of the dollar. And we've had one of the largest, sharpest tightenings in all history, regardless of what the Fed, right? The markets kind of did it for us and inflation did the rest. And that, when I look at that, it gives me kind of ISM getting down to 35. Now, the question is do the Fed even matter? Or will the markets price this? Because I think the bond yields start falling and eventually the yield curve starts steepening again. And the equity market seems to sense this. Now, whether it's too early or not, different matter for sure. But the point being is, do we even care about the Fed, or will the bond market be the truth?
Well, it's like the chicken or the egg. The Fed is extremely important. Without the Fed, there's no recovery in risk assets in March of 2020. Okay. So just as an example, without the Fed, I started in the business on October 19th, 1987. There's some of us, I think, that would remember that day. There's just a absolute cataclysmic decline from those levels without the Fed. And there's just countless other examples. Yeah. So the Fed, it matters a lot. And there's no way you can make a call on a steeper yield curve without making a call on the Fed, because the curve will only steepen two ways. Either bond yields ratchet up, and I guess that would happen if we had another inflation scare, or the curve steepens in a more benevolent way because the Fed cuts interest rates. But what I'm going to say is that when you look at the contours of the business cycle, since the Fed was created in 1913. You'll see very clearly that that the chart of interest rates and the chart of the economy, there's a near perfect correlation. It's just one lags the other. One lags the other. Interest rates lead economic growth, and the lags are long and variable. But that's exactly what's happened. So, yeah, I would say that we go back. For example, how did we do it? March of 2009, the stock market bottoms, and then in June of 2009, the recession ends. It took a lot without the Fed cutting rates to the bone, and without the Fed juicing the markets, like you mentioned before about financial conditions have tightened dramatically. Well, going back into the opening months of 2009, the Fed was dramatically easing financial conditions. Well, look what happens next. So yeah, the Fed is extremely important in all this, and so I'd say that that's what you need actually is the Fed. If you're gonna be bullish on the economy, you need the Fed to cut rates, which they're not doing anytime soon, and to re-steepen the yield curve. For what we're seeing right now, this is actually a bull market rally for pikers. I mean, good grief, we had bear market rallies that were 18% bear market rallies repeatedly in the tech wreck of 2001, 2002. We had huge bear market rallies. They're fun to trade. If you have the skill set that Paul Tudor Jones has, go run with it. Just make sure you have your exit strategy and you have your hedges on. We had countless. The biggest bear market rallies, the best days for the market of all time happened in 2008 and 2009. Most people don't realize that. So yeah, we have a bear market rally. It is, you can say, maybe it's premised on this view that we're going to have a soft landing. If you have a view that there's a soft landing, then the market bottomed in mid-June. That's not your view. It's not my view. If your view is that we actually have a recession on our hands, and then the next leg is not going to be even so much the multiple, but it's going to be earnings, then you have at least another 20% down from here. And that would be consistent with the historical track record of how the stock market behaves around recessions. There's a lot of psychology involved, and the markets like what Powell had to say. But the reality is this: the reality is that we are in the early stages of a recession, and the Fed still has a tightening directive on its books. We used to call this tightening bias back in the old days. Very few Federal Reserves would still be tightening monetary policy in this economic environment, but we're dealing with a much different inflationary backdrop. And the Fed has been shamed, and as a result, they're going to be very slow, I believe, to cut rates to save the economy. And by the way, this might all be very deliberate. We won't know till the transcripts come out years from now that this was a deliberate attempt to pull a Paul Volcker and kill inflation by killing aggregate demand for the greater good, short-term pain for long-term gain. And that might be the game plan. Anybody who's expecting Jay Powell to crap all over the economy yesterday during the press conference, well, why would he do that? He is a politician. The people think the Fed is a politically independent agency. How is that possible? It's a construct of the Federal Reserve Act. The Fed chairperson is appointed by the president, confirmed by the Senate. Oh, but they're independent, really. So of course he was a cheerleader. What are you going to do? Raise rates 75 basis points and say, look what I did in the face of this, so come on. But the thing is that, look, they made it very clear that inflation is number one priority. The real economy is number two priority. At some point, that's going to shift. They're going to cut rates, re-steepen the yield curve, but the recovery is not going to happen overnight. It's going to take some time because the recovery takes place really after the last rate cut. So, Raoul, what time frame are we talking about? Like second half of 2003? And then the stock market will see it, call it 3 months before it happens. So maybe the lows will be in the mid part of next year. But we're in a recession.
But then
and
is
the
the
Fed's
euro
still
dollar
tightening policy. So
is
to
the
turn
euro dollar
bullish, huh?
Is the euro dollar curve wrong then? Because the euro dollar curve suggests that the Fed starts cutting first quarter of 23.
I think there's a good chance that will happen, but it's going to be too late. I mean, so the futures strip is telling you they're going to start to cut interest rates. At that point, I mean, think about what you just said, that the Fed will start to cut rates. The markets have the Fed cutting rates a year after a recession starts. And I don't think Paul Volcker even waited that long. So you see what that means, that they're going to be so late. The corollary is they're going to be so late to ease. That's why this is going to be a really long recession. They're going to be very late. They're going to be very late to ease interest rates. As far as the economy is concerned, by the way, we won't be belly aching about inflation anymore. Okay, that's the positive out of this. But it's going to be. But you just mentioned it. They're not going to cut rates till the first quarter of next year. And then when do the recoveries usually start? Is more than a year after the first rate cut. So the recovery doesn't start till 2024. What's amazing is you have economists there saying the recession's not starting. I had Megan Green on my webcast yesterday saying that the recession's going to start in the second half of next year. I went, what? I think second half of next year. Well, I think by the end of next year, we'll be talking about the recovery. But you see, that's what's problematic here. The Fed is following lagging and contemporaneous indicators. They're freaked out about inflation, and they're still tightening into a recession. And the market's telling you, yeah, and they will not respond to the recession until the early part of next year.
So you're counting the recession starting beginning of this year. So therefore, by the end of this year, it'll be year one, and the recovery will come sometime end of year two, i.e. when growth turns positive again. Is that kind of how you're thinking of it?
Well, the markets will turn around before the economy turns around.
Sure.
But that I am saying, without being pinpointed to the month, that is probably going to be a second half 2023 story. So I think the economy will, if the Fed does look at, I think the Fed ultimately gets comfortable that it's killed inflation. I refuse to believe people that say the central bank has the tools to kill inflation. We've seen that before. And he compares himself to Volcker, which is maybe that's a good thing. Although I think that Volcker himself overdid it. It's a different story. The Fed's given us a lot of information. Right now, they're data dependent. It's hard to know what they'll do in September. I think they're either done or September is the last one. Jackson Hole will give us, I think, a window in August. But we have to always pay respect to the lags, right? The Fed stops tightening in the spring of 2000. The stock market bottoms in October 2002, more than 2 years later. And the Fed stops tightening and presses the pause button. Of course, each one of these elicits a brief euphoric rally that isn't long lasting. Ben Bernanke stopped tightening policy in the summer of 2006. When did the stock market fundamentally bottom? Well, we know that above the March of 2009, which is almost 3 years later. Greenspan finished tightening policy in early '89, and the stock market bottoms 2 years later in 1991.
And what about 2018? Which was, we were going into recession, the yield curve had inverted, all the forward-looking indicators were going to recession. The pandemic ended up being the recession, but it was all pointed that way. But the moment that the Fed said we're kind of on hold, the market took off because it has this Pavlovian kind of recognition of what that means.
Well, I don't know if the yield curve inverted in 2018.
Yeah, it did.
Because I remember the inversion happened in August 2019. We actually rallied into the inversion. But the reality is the reality. The reality is that I don't remember the yield curve inverting.
Inverted once and then again in 2019.
Well, I'll assume that you're right. I remember just looking at the chart the other day where the yield curve has given us one head fake in the past, and it was in the '98 Asian financial crisis when we rallied into an inversion, and then the Fed cut rates, and the recession started 2 years later for different reasons. But the reality is that even if you're right that the yield curve inverted 2018, we didn't have a recession in 2019. So that's the difference between a correction or drawdown, more like a liquidity event, even including October '87, and I started on October 19th, '87 in the business. The difference is when you get a plain vanilla correction, and it's based more on liquidity than the real economy, you retrace 40% of the previous bull market condition. And normally that's why you don't get much more than 20% decline, which we pretty well had back in the fourth quarter of 2018. But you see, a recessionary bear market is different because it's not just liquidity, which affects the market multiple. You actually, in a recession, get at least a 20% hit to earnings. And that's what makes a recessionary bear market different. In a recessionary bear market, you reverse 83.5% of the prior bull market condition. So that's what makes this beautiful, because if you believe in the soft landing, if you believe this was just a correction, and I think I saw Ed Yardeni on Bloomberg TV saying that, if you believe that this was a correction in a soft landing, and that means a 40% reversal from the previous bull market condition, then we bottomed at 3,700 back in mid-June. Arithmetically, that works out perfectly. If that's your view, go run with it. If it's a recessionary bear market, you reverse 83.5%. That takes you down to 2,700 on the S&P. So quite a different forecast. That's why the recession call is such an important call, because we haven't seen two things, really. We haven't seen the full mean reversion of the price earnings multiple. A lot of work has been done, not a full mean reversion. Mean reversion doesn't mean that you rest at the mean. The mean is just a horizontal line through time. Mean reversion means going from one extreme to the other. And historically, by the way, a recession trough multiple, not a soft landing trough multiple, a recession trough multiple is 12, not 16. And then you got to tack on what recessions do to corporate profits. Soft landings don't do a lot to corporate profits. Recessions crush corporate profits. And so that's why there's a big difference. There's a 1,000-point difference for the S&P 500 between a soft landing view and a recession view. That's how important it is.
Also, I remember when I first met you when I was at GLG, that was 2001, 2000, 2001, 2002, when you used to come into the office. Over that period, the market went up 2/3 more than it went down in terms of number of days. People forget, you talk about these bear market rallies. Most of a bear market is actually the price going up, which is really hard for people to get their heads around. They're pretty terrifying to trade sometimes.
Yeah. You've had, like I said, the biggest rallies of all time happen in the context of fundamental bear markets. And so they are fun to trade. The reality, though, is that you get these reflexive rebounds, and it's the power. Normally in a bear market rally, it's short covering, which is a different form of buying power than, say, just the retail investor coming in and buying ETFs. Short covering rallies can be vicious, and if you're still short, they can rip your face off. But they tend to be temporary. I mean, if we're going to call transitory, transitory normally but they can last a few months, right? They can last a few months. And this year we've had 7 bear market rallies since the peak at the beginning of the year, and they've averaged to be 6, 7, 8%. That's actually, as you watch all these people on Bubble Vision, they're all so excited. You go back to the tech wreck, market was down 50%, just about, the S&P 500. You go back to the great financial crisis, down almost 50%. We had several bear market rallies that were bigger than 15% off the interim low. So these bear market rallies this year that gets everybody excited. I mean, these are for pikers. These have been disappointing bear market rallies. They get snuffed out around the 50-day moving average, and 6-7% gets people excited in the context of a market this year at the lows. I mean, the cyclicals and the financials were down between 30 and 40%. I mean, the stock market basically handed it to you. I don't know. The Fed is not following market signals. The Fed is following contemporaneous macroeconomic indicators like the unemployment rate or JOLTS job openings or non-farm payrolls. Non-farm payroll shows up in the Conference Board's index of coincident indicators. They don't talk about the manufacturing work week. That's the leading indicator. He calls the claims numbers. Claims numbers are shot up more than 50%. That's a leading indicator. And so the Fed's telling you that the labor market is strong, but they're not really looking at the forward-looking indicators. The stock market. This is what you see. Whether or not you like Greenspan or not, and the serial bubble blower, I'll tell you, if you go back and read the speeches he gave when he was chairman, and you go back and you read the transcripts of what he would say at the meetings. This is what I do for fun. Okay, that. And a tall glass of single malt. Greenspan was, but Greenspan understood the symbiotic relationship between the markets and the economy. But he was a real market practitioner. And I'll take anybody on who wants to criticize Alan Greenspan. Look, nobody's perfect, but if you go back to Yellen, go back to Volcker, you'll see that Greenspan was absolutely just, I would say, a genius. And Bernanke, by the way, is an economic genius, but I don't think there's ever been a central banker that I knew that understood the markets as much as Alan Greenspan did. And he used the markets as a forward-looking barometer, because as a price, it's giving you a forward-looking signal. This Fed, I don't know. I think that we should all collectively put some money in and buy them a Bloomberg terminal. I mean, what do you think? Come on, Raoul, it's hilarious. The yield curve inverts. I actually wrote, I said, here's my forecast for the year. When the yield curve inverts, the intelligentsia is going to say, ignore the yield curve. And so Powell gets his economist, find me a part of the yield curve that's not inverted. Oh, well, what do you know? It's the 3 month, 18 months out. And okay, that's great. That's not inverted. Okay, oh, that's great. No, the yield curve's not inverted. I said they're going to dismiss the yield curve. It's got an 85% track record, but we'll ignore it. And then I said yet again, I said when we get back-to-back quarters of negative GDP, these clowns are going to find a way to say, yeah, it's not a recession. It's not a recession. I'm not going to say who. There's an anchor on Bubble Vision who said, I'm going to wait. I'm going to wait for the NBER to come out and make the
After the
declaration.
recession.
Gee, thanks. Thanks for. Do you know that if I went, when I was at Merrill and I went to the bond desk and I said, I'm going to wait for the NBER, I think that, I probably would have been killed. And, the thing, the NBER told us that the recession started in December of 2008. Thank you. It was 12 months old, but the recession is here. Thank you very much. Historically, the NBER tells you we're in a recession when we're already 7 months knee deep in it. So, I'm going to wait for the NB. This is not an NBER defined recession. Okay. The reason why people look at the back-to-back quarters of GDP is because it is simple. The GDP numbers are in front of us. We don't have to look at every single nook and cranny of the economy. It just happens to work. You got back-to-back quarters, we're in a recession. Oh, no, not this time. I mean, so anyway, the thing is that I love the call because, even though, but I say that those are my two best calls this year. Yield curve's going to invert. Everybody's going to say dismiss the yield curve. But how do you dismiss that the cyclical stocks, most of them in the consumer space, were down between 30 and 40% this year? Now, how does any economist, is the Fed even aware of what the stock market's telling you about a consumer-led recession? So you don't like the yield curve? That's fine. Oh, you don't like GDP? Oh, okay. But stock market, and especially the ratio between cyclicals and defensives, that's telling you a very powerful story. Unless you're going to say, you know what, the stock market doesn't matter either. I say this to people, my own clients, they're portfolio managers. But the stock market doesn't always get it right. Yeah, but you're a long-only equity manager. I mean, aren't you? So it's funny. And it's just basically, let's face it, Raoul, we're in a business where optimism wins out over pessimism 90% of the time. And then it doesn't 10% of the time. And you have these economists, and look, I spend most of my life on the sell side. Why would you, unless you hate your job, why would you jeopardize your career by making a recession call? I saw Brian Moynihan on CNBC today talking about how great the economy is. If I was still at Merrill, well, I guess it's called Bank of America now. I'm not going to go against the CEO. Oh, everything's just great. Back-to-back quarters of negative. Oh, don't worry. It's only inventories, and it's only consumer spending on durables, and it's only housing, and it's only CapEx. Don't worry about it.
Hey, listen, Dave, question. Inflation, right? So I'm looking at inventories, which are super high and need to get liquidated, and that usually means prices need to get cut. I'm seeing commodity prices coming down. Oil's the last shoe to drop. Obviously, wages tend to be lagging, but everybody's still yelling about inflation. My actual core view is becoming, not 100% there yet, that we go to deflation in 18 months' time, just mathematically. Now, maybe not at core level, but at headline level.
Right.
Where are you on inflation? Have we peaked out? What's your whole structural view on this?
Well, I certainly think that we peaked. I hope at 9% plus. That's not an outlandish call. How far and how fast? Look, firstly, inflation, we're all consumed with inflation. It's a lagging indicator. And in fact, one of the components of the Conference Board's index of lagging economic indicators is service sector CPI, which is dominated by what? By rents. And look, so much of the CPI, Alan Greenspan called it in one of these transcripts going back in 1996. These are very interesting. The transcripts read like a Shakespearean play or a Greek tragedy. And he's having a back and forth with Janet Yellen. and he calls the CPI a flawed statistic, which is why he relied more on market variables. I think you're right. I think what's more important is why is the five-year forwards back down towards 2%? Why are the 10-year break evens at 230? When you look at the 10-year break evens on a core basis, when you consider what food and energy have done, it's below 2%. I always thought, boy, it's interesting. Everybody's talking about Fed credibility. Well, the dollar's been in a bull market. We have a flat to inverted yield curve. We got these break evens have been coming down. Now commodity prices are rolling over. We've had dollar strength. Normally, if the Fed's credibility was under attack, look, it's been under attack from Larry Summers and from Bill Dudley, academia, the media. The Fed has felt a lot of the heat, except from the markets, right? And we would have had the mother of all bear market steepeners and would have had a faltering US dollar if we were turning into Zimbabwe. We just basically, I think you're right on the money. Look, it's been very unfortunate. We've been hit with a series of shocks, supply side shocks that were inflationary. Omicron and the impact on the participation rate. And then we had China shutting down 400 million people in key port cities, affecting global supply chains. And then, of course, the impact on global food and energy from the Russian invasion of the Ukraine, and that just catapulted. Now, before that, inflation was already rising because the economy reopened far faster than anybody thought. And of course, we had these, both under Trump and Biden, these massive stimulus checks. So, yeah, we had a sclerotic, inelastic supply curve bumping against fiscal and monetary stimulus. And here we got the inflation coupled with all the supply bottlenecks. But you know what? That's all in the rearview mirror right now. Inflation, like I said, is a lagging indicator. The 30% of the CPI is rents, which the OER part of that, owner's equivalent rent, is a survey. It's such a funky statistic, the CPI. So much of it is imputed. The rents will come down with a lag. I don't know if the deflation is 18 months, but you could be right. I'm sympathetic to that view. It could be 24 months. The rents will be slow, and there's such a big weighting, but they will follow the housing market lower. That is going to happen. It's a matter of lags. I think that you're right in the sense that the swing factor, look, when we go back how we swung from inflation when oil was touching $150 a barrel in the summer of 2008, if you told anybody a year later that the CPI was going to be negative 2% year over year, we're going to swing from +6 to -2. You know as well as I do that you'd have been carried out in a gurney, because I think they tried to do that when I was on the bond desk at Merrill telling them this story. And we swung from +6 to -2, and it wasn't, rents didn't deflate. And services don't typically deflate. They're very sticky. That much is true. But you see 40% of the CPI is goods. And we're going to have lagged impact of the supercharged US dollar. And we already, by the way, you're starting to see this already in the core crude PPI, which was negative, which is negative 2% in June. It was negative 4% in May. That's a leading indicator. The core crude PPI is a great leading indicator for goods. That's how people talk about rents. Rents are 30% of the CPI. Yes, I know that, but guess what? Stuff, material, furniture, appliances, autos, they are 40% of the CPI, and they will be deflating. And that's the swing factor. If you look at the year-over-year percent change in services, it will slow in a recession, but it doesn't deflate. The swing factor is, just as you said, it's the 40% of the CPI called goods. And the combination now of all these commodities, I think everything except for eggs is lower now than it was before the war started in the Ukraine. These commodities have come way off. We haven't seen the peak impact of the dollar just yet. This will all cascade. You're 100% right in goods sector deflation. And the question will be how much of this will offset whatever lingering service sector inflation we're going to see. But I agree with you. I think inflation is going to come down materially in the next year. It's just that my problem is that the Fed has become a little dogmatic in this respect. Once burnt, twice shy. So you see what I mean, Ralph? Once burnt, twice shy. They're going to be purposely slow because they don't want to get burnt again on transitory. That is unfortunate. That's what's going to lead to another policy mistake. They made one already. It's hard to know if it's a mistake. This all might be deliberate to send the economy into recession. But comes down to how much longer the recession will be, because I could tell you this Fed is going to be deliberately slow when it comes time to having to ease policy to put a floor under GDP.
Let's talk about this for a bit, Dave, because there's a whole bunch of market participants. We're all splitting into two camps right now. One is that my view, which is inflation is not a problem because of debt demographics, technology. But there's a whole group that think it's secular because supply chains and commodities are broken for longer. There's not enough supply, and that reshoring of businesses is going to drive up costs and demand for materials, and therefore this is a secular inflation cycle. And Raoul, you're an idiot. This inflation is only going to come down to 5%, and then we're stuck with inflation. The bond market's toast, the equity market's toast. This thing's going on for another 5 years. What's your view on that kind of cyclical versus secular inflation?
They might be right. I don't know if there's going to be a lot of onshoring. There'll be nearshoring. I think Mexico is going to be a big recipient of those direct investment inflows, and it's already starting. Mexico is a low-cost producing country. You know, people were saying this back, 10 years ago when China's working age population started to go down and their wages were going up. People were saying, oh, well, China is no longer a source of global disinflation. That proved to be dead wrong. Remember, people were saying that, and that China was becoming a higher cost producer, but it never really showed up in the data. We're going back more than 10 years. People were saying that. But I'll be respectful in the sense that it makes sense in some industries, not all industries, but certainly in pharmaceuticals and in semiconductors and food, that security of supply has become a national security issue for every country. Okay, I'll buy into that. But what is really the impact is so imperceptible over time. That's not an inflation shock. Is it something that is against our view, me and you at the margin? Okay, I'll buy that. But the demographics are certainly disinflationary. People talk about demographics and the impact on the supply side and availability of labor. But as you said before, over time, technology is taking over that, and the capital labor ratio is going up. It's not going down. So there is ongoingly labor displacement. I mean, the only labor shortages in the United States are really in low value add, low skilled service sector industries that are a relatively low percentage share of the economy. So aging demographics, I mean, demographics is destiny. And as Richard Koo would say, and when people talk to me about the impact on inflation from aging demographics, it lines up more. And there is an impact, by the way, on both supply and demand, but the demand overwhelms the supply. And you've seen that in Japan. The two oldest nations are Japan and China. They have the lowest inflation rates consistently. Why is that? Well, I wonder why. Because of the impact it has on aggregate demand. Because as you get older, your shifting patterns tend to change, and that's why a lot of the inflation in the 1970s that people talk about, always about Arthur Burns and about Richard Nixon, lots of mistakes were made. But we had a vibrant young baby boom population that was fueling demand. People don't quite understand that in this so-called sclerotic, just horrible 1970s, that even with three recessions from 1970 to 1980, aggregate demand in real terms averaged 5% per year. When was the last time the U.S. economy averaged 5% per year for a decade? 1970s, actually. Now, of course, we had three Fed-induced recessions. We had an inflation problem. A lot of that was about demand. So I guess when these people come back and say, well, so these are the forces of the supply side, globalization, so on and so forth, the question comes down to what's happening with demand. And because you can't just forecast inflation with one curve, you need to have a supply curve and a demand curve.
Everyone's a supply side person, and nobody looks at demand. It's amazing, even in commodity markets.
But that's the shifting story. If we had a whiteboard behind us and we were pretending we were economic 101 professors, we would be showing what's changing this year is the demand curve. Okay. By the way, the supply curve is becoming less inelastic, not more inelastic. That's a new story too. But it's the demand curve this year, the demand curve. And that's what's going to overwhelm the supply curve. And that's why your deflation call is going to come to fruition. I can't say for sure if it's 18 months or if it's 36 months, but I think that we're going to go back into deflation as well. The demand is contracting. We have never, I got data back to 1960. We have never seen a period where we've had monetary and fiscal contraction like this simultaneously. The same yahoos that were talking about the money supply numbers this time last year, when they were running, if not double digits, triple digits, nobody's talking about the money supply anymore. The monetary base is actually deflated 4 straight months. It's negative year on year. And that is the root of all monetary creation. The money supply and M1 and M2 have collapsed in terms of their growth rates. They're back to where they were pre-COVID, when we weren't really talking much about inflation. So I would say that what's changing right now is the demand curve. And the Fed is doing this deliberately. So many things have changed. Now, you can go back a year, 18 months ago and say, well, but we missed this too. We missed the fact that the supply curve was becoming more inelastic. Aggregate supply globally is shifting to the left. And we have rampant monetary and fiscal stimulus. So we have rising demand bumping against constricted supply chains. And hence we get big inflation. But that's yesterday's story. So we got to continuously focus on what's changing at the margin. Well, actually, when you look at the anecdotal evidence, you're going to see that the supply delivery delays in practically every manufacturing survey is going down. Now, is it back to where it was pre-COVID? No, but it's going down. Order backlogs are going down. Look at the Baltic Dry Index. It's down like 40%. You're seeing freight rates coming down. This is a different, now, the supply curve is still inelastic, but what I'm saying, because change is always at the margin, it's less inelastic than it was at a time when demand is contracting. So what is anything that you've ever seen in theory or in practice that would tell you that when demand is going down faster than supply, you get more inflation? No. You get less inflation. And the question is going to be how much. Now, admittedly, the way that CPI is constructed, and of course, I'll tip my hat again to Powell that the PC deflator is really what they focus on more. But let's just say both indices are dominated by services, which are slower to react to changing economic circumstances. The good side is really where we're going to be seeing the deflation in your story. And I think that inflation next year is going to surprise a lot of people to the low side. That will be the catalyst. Ultimately, that will be the catalyst for the Fed to ease policy aggressively. And it's not going to be to bail out the stock market or bail out investors. It's going to be naturally the natural course of events in a business cycle. Interest rates are cyclical. People are going to say, oh, there they go again. They're going to be cutting rates. Well, they're going to be following the bond curve. The bond market's going to be telling the Fed, you have to start cutting rates. You're telling me right now the futures curve is telling the Fed you're going to be cutting rates next year, but only a couple of times. No. Raoul, how many times in the past has the Fed cut rates a couple of times in a recession? No, they cut rates a couple of times in a soft landing. In a recession, the Fed cuts rates 500 basis points. The Fed cuts rates 500 basis points. The reason why they've had to do QE the past couple of years is because they're not going to cut them below zero and kill the money market mutual fund industry, which is the cornerstone of funding for short-term funding for the corporate sector. So they create the synthetic negative interest rate by doing QE. Well, let's just put that way out into the future. But the reality is that, and this is what we should be asking ourselves, we are in a recession. Okay, I am not one of those guys that has my head in the sand. Okay, I don't suffer from career longevity. I could say what I want. I'm not going to get fired. You know why? I'm not going to fire myself. So there's so much information that we have. We should be asking ourselves, well, how do they get out? We have no fiscal stimulus. Fiscal policy is dead on arrival. Okay, the Republicans are taking over the shop in November. It's done. In fact, Joe Manchin, just think about it, signs this deal. Now it's got to go to the Senate, where the tax increases are bigger, the revenue increases are bigger than the spending increases. So Schumer and Manchin just signed on to ratify a fiscal contraction at a time when the Fed's tightening monetary policy. And so the question is, in next year, how far will the Fed have to go to cut rates? What will they do for an encore? What other rabbits are in the hat? Now, remember, the sort of QE that they did last time, they have to get congressional approval to do what they did, to buy. I had people asking me, they're going to buy equities. Will they pull a Bank of Japan and buy equities? Well, the only reason they were able to even buy corporate debt and go outside the realm of AAA rated securities was they needed to have congressional approval. That's unless things get really bad, that's not going to happen again. And you know what? Maybe there's something to be said. Maybe we'll find out in the transcripts that all along, once again, they were talking about harvesting bullets. We got to harvest bullets, got to harvest bullets. I always wonder about harvesting bullets to fight the next recession. It's like, you know what? Oh, it's like the surgeon will amputate your leg and then reattach it the next day. Okay, gee, thanks very much. We're going to collect bullets that we're going to have to, but I mean, that's just the reality of the situation. Interest rates are cyclical. This isn't about, we're going to be hearing, oh, there they go again, bailing out. Well, I don't know if we go back to 2,700 in the S&P, or if you're right that we fully reverse. Look, half of the recession bear markets post World War II, and this is where you're probably going to be right, I think. Half of them, you had 100% reversal. You went back to where you started from in the previous bull market. That takes you back down to like 2,300.
I'm not as negative equities. I'm kind of somewhere between 30 and 40%, but I'm not that negative equities in this. I'm negative the economy, and I think it's deeper than people imagine from my forward-looking stuff, but we'll wait and see. But this does lead us into, okay, we've talked about growth is imploding. We've talked about the likelihood of inflation imploding. We've talked about a troublesome equity market. So that leaves the standout trade, which is bonds.
Yeah.
And people, when I mention this, a lot of people who are not used to bonds, I mean, you and I have been around a while and we know how bonds work, are like, are you crazy buying bonds with 9% inflation? I said, that's exactly the time to buy bonds. Talk you through it. You're also bullish bonds, I take it.
Very much. The inflation rate is a lagging indicator. So I don't really formulate forecasts based on the inflation rate. Do I wish that I would have known we were going to go from 2 or basically 0 to 9%? I wish I was that good. I would have known that was going to happen. I don't know if we call that a 3 standard deviation event. Oil, the front month contract for oil in the spring of 2020 is negative, and then we go to 120. Well,
one point about that. If you'd have known it was going to 9%, we would have said, okay, where are bond yields? We would have probably said 6, and they went to 3.5. That's got to tell people something, right? There is a structural issue here, much larger than people expect, because every bond bear basically got this wrong. A few people nailed the early move.
Fair. It's a fair point. It's a fair, and look, we got stopped out at 3.5. The peak in the 10-year note was in April 2010 in the last cycle, and we peaked at 4.01. We were there for one day in early April of 2010. Most people don't know that, and it's interesting we got stopped out at 3.5 this time around, because the pattern of hitting lower highs and lower lows is still intact, which is why the secular bull market is intact until otherwise notified. It's not about the size of Bill Gross's pencil and ruler. Okay, the sequence pattern of lower highs and lower lows in yield remains intact. I think that the way you put it, I think, is very, very accurate, very elegant way of putting it. And you're right that we got stopped out. Look, and I think as the bond market is actually quite sophisticated, it realized that, yes, we had a series of supply shocks that are not permanent. And I guess that's what transitory means. It's not permanent. Look, we have the first shooting war in 80 years in Europe. We've had these recurring supply shocks. Complicating it was really quite unnecessary fiscal stimulus for the most part, stimulus checks that got spent right away, exacerbated for a period of a year. It's funny that Jay Powell says, yeah, we've had this inflation now and it's lasted about a year. It's lasted a year. He makes it sound like a year is a long time. I'm there thinking, because I fancy myself as an economic historian, a year in the overall annals of economic financial history, I don't know. I think that might well be transitory. Look, the last time, sample size of 1, that we had a war and a health crisis that went global was back, say, from 1916 and 1920. We back then, the war started first, then the Spanish flu. We had 4 years where inflation averaged 15% per year. Now, we didn't have like social media back then, but we had inflation that wasn't 9% for a year. We had 15% over a 4-year period, because we had a series of supply shocks. Wars historically tend to be inflationary, and we had a global supply shock on top of that from what happened with the Spanish flu. Once those pressures subsided, and they didn't last indefinitely, okay, there are no new eras. Excesses are never permanent. Once those pressures subsided, we went through 10 years of deflation from 1920 to 1929. And then, of course, we got the mother of all deflation starting in October 1929. I can't remember the exact year that F. Scott Fitzgerald wrote The Great Gatsby. I think it was 1926. Nothing in there on the Great Inflation. It was only 6 years earlier, right? But memories faded. And so I would say that this inflation that we had was transitory. If you're willing to be charitable on how you want to define it. And I think that we are going back into a deflationary period. I think you're 100% right. And I think that the Fed is going to exacerbate that. And remember that, and people got to remember that the lags between what the Fed does in time A and the peak impact on the economy in time Z, the lags are long, variable, and in this particular situation, very insidious. And that's what I mean, is that the recession has already started. I'm wrapping my head around this. The recession's already started. The Fed's still tightening policy. And the peak impact is not going to be until the mid part of next year. So I'm just going to say we are locked into right now. There's no turning back. We are locked into a 6-quarter recession, and it might even be longer than that. That's where I come down. And so I'll tell you this much. Even in the 1970s, we had a recession in 1970, 73, 75, 1980. In recessions, guess what? Even in the stagflation era of the 70s, in recessions, demand gets so weak that inflation melts. The question will be, and the question in the 70s was that when the recession ended, inflation went right back up again. Well, as you said, what was technology back in the 70s? What was that? Like an IBM mainframe and a transistor radio from Panasonic? I mean, where productivity was non-existent. And you had a different labor market, a different level. People talk about, it's funny that you mentioned globalization. You didn't talk about the return of labor power. The return of labor power, please, because these young people are job hopping in the restaurant and accommodation sector. That despite all the hype and rhetoric about, Amazon workers here, they're certified now, the union and Starbucks over here, what is it? It's over 300 million workforce. And you read the headlines of the Wall Street Journal. Wow, we got the return of labor power. That's not happening. It's happening in a few sectors. It's not happening. In fact, the share of the private sector workforce that's unionized last year went to a new post-World War II low. So there you go. In the 1970s, it was inflation was almost institutionalized because the economy was unionized and everybody had cost of living allowances.
And also, Dave, as you know, the labor force participation rate is super low because of demographics. So if the group of people in a job gets a 5% wage increase, half of the labor force is out of the job. So therefore, you have to half the total aggregate demand of the wage increase, which is 2.5% and not 5%.
The proof of the pudding is in the eating. I mean, the participation rate, the participation rate in the United States, it peaked 20 years ago.
Yeah.
Before COVID and all these supply shocks, inflation was like 2%. Donald Trump could actually cut interest or give us $1 trillion tax cut, and the Fed could continue re-embark on QE in 2019 with 3.5% unemployment rate at the lows, and inflation was 2%. And so, yeah, you're 100% correct on that. But it's like I said before, aging population. It's all about people talked about the great retirement. Yeah, okay, so there's the great retirement as long as that lasted. Now people who've seen their 401ks depleted, they'll come back into the labor market. But be that as it may, the participation rate's been going down for over 20 years, and there was no perceptible inflationary impact whatsoever.
And don't forget, when they come back into the labor force, they're competing with their kids and they're doing part-time work, and they'll do it cheaply because they're only topping up income, which is a natural lower of aggregate wages because, the 70-year-old's coming in and he's doing Uber driving and all he or she needs to do is do it for 20 hours a week to top up their pension. And so that takes away from the net employment of the 32-year-old who's their kid. It's people don't look at this stuff. They just look at headline numbers and never think through what's actually happening.
Well, there's something else that is going to feed into this because we're talking about the labor market. And I find it very fascinating, for example, that we get the GDP numbers for the second quarter. Private sector GDP was negative 0.7 annualized. But we know that labor input, aggregate hours worked, was up 2.7%. So what falls out of that is negative 3.4% on productivity quarter on quarter. This will be the third decline in productivity in the past 4 quarters. And it would mean the productivity in the world's most dynamic economy is negative 2%. When people say to me, so what do you make of today's GDP number? I said, I'll tell you what I make of it. It means productivity contracted again. You can count on your hands the number of times in the past 60 years that productivity was negative 2.0 year over year. And each time we were in a recession. The question becomes, how did the corporate sector respond to that? Because you see what happened here is, and this comes down actually to the Fed. It's funny, Raoul, that everybody criticizes the Fed for missing the boat on inflation. But everybody seems to be giving the Fed a pass on missing the boat on the real economy, because we went into this year, the Fed was, in its projections, was saying we're going to have real GDP growth of 4%. At the June meeting, when they produced their last set of forecasts, it was 1.7 for this year. I'm telling you right now, it's going to be 0. Maybe there's an outside chance it'll be fractionally negative, but you can see that if you're a business executive and you're following the Fed, they have 300 PhD economists on staff. You went into this year with the Fed telling you +4 on real GDP. You had to be thinking, I have to pre-order, I have to build my inventory, I got to hire more. But look what happened. Look what we can see in the retail and wholesale sectors in particular, massive excessive over stockpiling. We have an inventory problem. But you see, not just an inventory problem, they hire too many workers. I mean, can you imagine the context of the first half of this year, the economy actually contracted? And yet, over the past 12 months, the average non-farm payroll number was plus 520,000. We went into this year over stockpiled by all the pre-ordering. Now that's got to be liquidated, 100% right. But what about employment? Because I've got to tell you that if we're going back to a situation where the corporate sector is going to have to right-size their productivity, or they're going to lose it on margins big time. So unless we get a revival in output, which seems next to impossible, because we know that the Conference Board's leading economic indicator is down 4 months in a row. And so we have more economic pain ahead. And so there's a misalignment between company order books, production schedules, and staffing. So what's going to happen when you do the arithmetic on what it will mean to right-size productivity? And you're already starting to see it happen, but not in bodies, but hours worked are starting to come down. And that's a great leading indicator. Hours, you're talking about, Raoul, you're talking about in the next year, 2 million jobs are going to be lost.
I mean, Amazon made this clear, right? Amazon are about as good a company on earth as managing inventory of people, products, and everything else. And they came out in Q1 and said, we've wildly overstaffed. And that was the signal to me. It's like, oh my God, if Amazon, and they were the first to say it, they're like,
it's endemic.
It's endemic. It's everywhere.
Yeah, it's everywhere. Well, so this, you see, this is what's interesting is that Powell says, why no recession according to the Fed is because the labor market's so strong. It's an illusion. And the question really is, what's the labor market looking like 3 and 6 months from now? Nobody talks about the fact that we are in a huge productivity recession. It is not sustainable. And unless you believe we're going to have a rebound in output, which no leading indicator is suggesting we're going to, employment is going to have to be right-sized. Now, in the past year, we've created 6 million jobs. I'm not saying all 6 million go by the wayside, but a third of that is going to go by the wayside. And if that's the case, which I think is going to be normal, and an actual part, the reality is that the business sector, everybody made mistakes. And if you followed the Fed's forecast at the end of last year, not on inflation, but they bungled it on the real economy. Nobody talks about the fact that it's all about transitory. Nobody talks about the fact that they had a 4% growth forecast, and now GDP growth for the year is going to be zero. Companies overhired. Now they have to basically correct that process. It's going to be pretty painful. 2 million job loss in the next year is going to be pretty painful. It means the unemployment rate is going to head back up to 5% from 3.5%, and that alone, when you trace out what that means for wages as you build more excess capacity and what used to be a tight labor market, wage growth goes from 5% to 2.5%. So you see what you were saying before. I mean, let's hope. Getting inflation down is going to be very important because wage growth is going to be dissipating. And so you got to get inflation below 2.5% in the next year to start creating the process where real incomes start to expand again. So what I'm saying is that in the next year, even as inflation goes down, wage growth is going to go down just as much. And we're going to maintain the cycle of negative real personal income, which represents 70% of the economy, otherwise known as real consumer expenditures. And that's why this thing is going to last, I think, at least for another year. It's a lock. I just hope it doesn't last much longer than that, but a lot is going to depend on the Fed's reaction function. The signals are giving us right now. I mean, you got to be very disappointed, Raoul, that you're telling me that the market's got 2 cuts for next year in the context of recession that's already started. Wow, that tells you that's telling you right there that the market's telling you the Fed is going to be too slow to react as far as the real economy is concerned.
Final question. Where do you think bond yields go in the next 12 months?
I think that the 10-year, I think we're going to break below 2%. I think that we probably will get to 1.75. And I'll just say that if you're bullish on equities, you have to know that at the lows, historically, the 10-year note yield and the dividend yield tend to converge. That's when the alarm bell, that's when you get the real relative valuation support for the equity market. Well, what's the dividend yield is 1.6. The 10-year note is, call it 2.8. Well, maybe there's a meeting of the minds in between, but either the 10-year note goes to 1.6 or the S&P might have to go to, well, it would have to basically go down around 2,200 or there's a meeting of the minds in between. But everything that I'm seeing, by the way, you need to get, if you're bullish on equities, you have to be bullish on bonds first. There's never been a recession low in equities that wasn't followed by a huge rally in treasuries. So when people say to me, what do I do? What do I do? What do I do?
Preceded by
buy bonds first. And I think in an overshoot to the downside, we can get to 1.5%. But I'm thinking we're going to break below 2%. And at that point, I'll make up my mind as to whether or not it's time to take the bet off the books or double down on it. It'll be situational, predicated on where we are in the cycle, the degree to which my call has worked out or hasn't worked out. But I think it's, as much as there's anything as a no-brainer of a call, and they don't typically exist, but I say that in recessions, by the way, in recessions, inflation goes down. Yes, how much? That's the question mark. But in every recession, bond yields go down. There's really never been a recession where bonds didn't make you money total return. Now it's more challenging today in the sense that you don't have the coupon, but then again, the convexity gives you a nice capital appreciation. If I'm right on where the 10-year note's going to go in the next year, I'm not saying, I mean, you can go and buy long dated zeros, or just buy long bonds. I'm just talking about the 10-year note, 14% total return in the next year. My call comes to fruition.
Dave, as ever, fantastic to speak to you. Really interesting. Let's see how it all plays out, but it's going to be a very interesting 12 months, I think. Did I lose you there?
No, no. It was just that you started to slur your words, so I was saying that you should hide that bottle of tequila, but I think it was just your microphone. Yeah, I think you finished off with about you mentioned the word interesting year. It reminds me of when the Chinese proverb about may you live in interesting times, and people say that without knowing that it's a curse, not a blessing.
Exactly. Dave, as ever, really appreciate your time and your thoughts.
My pleasure, Raoul.
So what do we learn from Dave today? What we've learned is Dave has a variant perception on where the economy goes. From all of his work, he thinks that growth is going to be weaker. He thinks people are focused on backward-looking data, but he also thinks the Federal Reserve might be slower to cut rates. Now, mainly people would think, well, that means that bond yields are going up. But it's not, because what Dave's saying is bond yields are going to start pricing in the fact that they're too late in cutting rates. And therefore, bond yields come down well before the Federal Reserve does. Dave also thinks that the equity market needs to price in further recession, and that this recession is already 6 months or 8 months in, and it's going to go for 2 years before we get to recovery again. So it's a longer process, but we're already in the thick of it. David also has sympathy with my views that inflation probably comes lower. Like me, he hears the argument that maybe some of the supply issues could be more structural, but again, he kind of thinks it's going to be overwhelmed by the secular themes of debt, demographics, deflation, globalization, and those other issues. So lots to get out of this. And again, we join all of the macro dots here of how the economy all fits together, all the component parts, what's leading, what's lagging, and it comes out to a very simple proposition: buy bonds, wear diamonds.
We hope you enjoyed the video. At Real Vision, we help you understand the complex world of finance, business, and the global economy with in-depth analysis from real experts. Join the revolution at realvision.com.